Good morning. Welcome to Trading Hour. I am Reema Tendulkar with Mia Pavitra Parekh. We're back after a truncated week and into another holiday shortened week. So these are good tidings, but of course we are going to be inundated in terms of news flow. This morning, things are on the quieter side. The Nifty is trading in a range of just about 50 to 60 points, and it helps that, despite having a long weekend, there were no big negative cues that markets were contending with. So we're pretty much holding on to all the gains of last week, where the Nifty and the Sensex gained about 1.5%. The Nifty conquered the 50-day moving average, the 200-day moving average. This morning, some of the Asian markets, like the Nikkei, the Korean markets, are holding up in the green. They've got gains of about 0.5 to 1%. The FIs have been buying in the cash market. They've been bringing down their short positions in the F&O market as well. So things are on the quieter side, and as I said, there are no big negative cues that the markets are contending with this morning. Mid-caps were outperforming, though the mid-cap index has seen a bit of a come-off from the top of the trading session. So the mid-cap index was up nearly about 0.4%, but now those gains have come off to about 0.2%. The advanced decline ratio right now at least is holding up in favor of the gaining side. The top sectoral gainer is the realty index, that's higher by 3%. After that, you've got the auto index firing, particularly led by Tata Motors. Banks are seeing some profit taking, but this comes after 6 days of consecutive gains. So after that, the Nifty Bank has given up close to about 160 odd points. But lots of cues to watch. So domestically, earnings from TCS and Nifty this week, then HDFC Bank on Saturday. Globally, JP Morgan Chase and Citibank will be reporting their numbers. You've got inflation print from US and India. Even the India CPI number will be very important after RBI's pause last week. And then you've got the Fed minutes. So lots to track over the next couple of days.
Oh, absolutely. Even if it's a shortened week, we have,
our hands full.
Our hands full for the next 4 days. Reema, like you were pointing out, it is the real estate pack, right, which is doing the best. It's up over 3% today. But on Thursday as well, we saw a big rally after the RBI paused on rates. So in 2 sessions, it's up over 6%. Also, you have a lot of the updates coming through, right? That's also really helping. So Godrej Property, I'm just putting a few of the names up on your screen, but pretty much that entire space is holding up quite well. There you have it on your screen. Like Reema was pointing out, it is the banks which are taking a breather and some of the larger private banks at that. So keep those on your radar. Reliance soft once again in trade, so I would watch for that. And for the auto pack, you have very divided news flow. Tata Motors is the top gainer on the Nifty. It's up 7%. We'll talk more about that. Maruti seeing some cuts on account of a big downgrade that has come through in spite of the, positive news flow on the CNG price cut. So we'll talk more about all of that. But first up, let's kickstart with the big story of the day. The government has accepted suggestions of the Kirit Parekh panel on gas pricing. So Sonal is standing by at the big wall with all of the details on this one.
Well, yes, this has come as a material relief to the gas users as the government has accepted Kirit Parekh committee recommendations and has amended as to why gas is and how gas is priced in the country. So let's understand some basics first. India consumes around 150 to 160 MMSCMD of gas totally, out of which 50% or 80 MMSCMD is produced in the country and rest is imported. Out of this, 77 to 78% is the gas under APM or administered price mechanism, and rest is non-APM. Out of the total production, 83% is produced by ONGC and Oil India combined, and rest is basically private players or JVs. So the change that has come about is in the APM gas pricing. Let's first talk about what was the gas pricing scenario earlier. APM gas prices, they were basically decided on basis of a formula, which is the weighted average price of 4 global benchmarks, that is US Henry Hub, Canada-based Alberta gas, the UK-based NBP and Russian gas. It was revised every 6 months and it was set at $8.57 per MMBTU as per the last revision. Now there has been a change to that. Gas prices will now be announced every 1 month. The prices will be pegged at 10% of international price of Indian crude basket, and to protect the interest of consumers, there is a ceiling to this. The gas prices, that is $6.50 per MMBTU, and the floor is at $4 per MMBTU, which is for the benefit of producers. Now it's important to note that ceiling will be maintained for FY24 and FY25, post which this will see an addition of $0.25 per MMBTU every year. Gas from non-nomination blocks of oil and ONGC will have 20% premium to APM prices, and there is no change in pricing regime for difficult fields or any LP blocks. Now, this change was brought about because of the way gas prices moved during the Russia-Ukraine war, as the global supply of gas was impacted. This led to prices in Europe going up by 3 times, prices in the US touching new highs of $9 per MMBTU. This led to higher prices in India as well. And that is the reason why CNG prices in our own country and city shot up by 80%. So that is the kind of move that we saw in 2022 as well. Now let's move on. After talking about how CNG and PNG prices went up, that was the reason why the government went ahead and set up the Kirit Parikh committee. But with the new pricing regime change that has come in from here, we will see that the prices have been set at $9.16, that is April 1st to 7th. Post that it is at $7.92 per MMBTU. But again, the ceiling is at $6.50 per MMBTU. This has come in as a big relief to city gas distribution companies. IGL gets around 80% volumes from CNG and PNG segment, MGL at 87%, and Gujarat Gas at 36%. So the first two tend to benefit the most. As a result of all this, there have been massive price cuts by all the players. MGL has cut CNG prices by 8 rupees, PNG by 5 rupees. We have seen Adani Total Gas cutting CNG prices by 8 rupees, PNG prices by 5 rupees. There's IGL which has cut prices by 6 rupees. GAIL Gas has cut prices by 6 to 7 rupees per kg, and this has come as a relief to consumers as well. But for producers like ONGC and Oil India, in the near term, there will be a hit to their realizations, with both of them seeing cuts of around 24% as for brokerages. But of course, in the longer term, it's a positive because of the floor. Brokerages are positive on the entire city gas distribution space. Jefferies has upgraded the EBITDA estimates by 6 to 20% for all the three companies. For GAIL, it will lead to a savings of 1100 crore rupees for LPG segment due to lower gas costs. Morgan Stanley says that not only city gas distribution companies, new pricing mechanism is a positive for producers as well and removes a multi-decade overhang on long-term returns. And CLSA says despite the price cuts, margins will be positive for MGL and IGL, and this takes discount of CNG versus diesel back to 30% and brings back the pricing power. Government's intent to assure $75 to $80 barrel realization also raises earnings predictability for ONGC and Oil India.
Sonal, thank you very much for that. That's the big story, right, for the day. We'll also listen into what Kirit Parikh had to say on this development.
The APM prices recommendations that we had made were following that it should be fixed within a floor and a ceiling price, and that is accepted by the government. The same floor and ceiling we had suggested, $4 per million BTU and $6.5 per million BTU. I think the consumers will are getting cheaper price for the PNG and CNG supplies. Second measure the government has taken is that it has provided 20% additional money or price increase for gas that is produced by ONGC and OIL.
All right, that is the word coming in from Kirit Parikh on this new gas pricing. But remember, a cut in CNG prices, like we were just talking about, will impact a lot of sectors, right? Such as the auto pack. In fact, Sonia is standing by to tell us why this is, a big positive specifically for Maruti. Sonia.
Well, thanks a lot for that. Absolutely. So a cut in CNG prices is definitely positive for a company like Maruti. Now, remember, Maruti, about 5 out of 10 cars that are sold, CNG cars, come from the Maruti stable itself. And Maruti has a large presence in this particular space. So if you look at it, about 15% or 16, 17% of Maruti's overall revenues comes from the CNG space itself. And Maruti had indicated that they are hoping that the CNG segment itself grows for them about 20% in FY24 because of the the lower CNG prices. So this is of course a positive for Maruti, but the reason the stock is under pressure is because there was a downgrade that came in from Goldman Sachs. So the small car segment in general has been under a lot of pressure and the demand has been weakening there. But a fall in CNG prices is something that will definitely be positive for a company like Maruti.
Sonia, thanks a lot for getting us all of those details. That is on Maruti. But with that, we are going to get into our first short break on the show. On the other side, there are a lot of more stocks that are in focus on the back of their business updates. So we'll fill you in with all of the details when we come back. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. The market is holding up with a 40-point gain right now. The mid-caps also, completely in line. They have come off a tad right now, but it's still holding up with 0.25% in terms of a gain. The only pressure and pullback that you're seeing is really coming through from the Nifty bank and some of the consumption names which are seeing some cuts. We'll talk more about that, but one space which is really buzzing around is the real estate space. We have stocks like Godrej Properties, which is up, which is up 7%, Sobha up over 3%. This after the companies have posted their Q4 business updates. So Sonal is here with the details. Sonal, looking very good.
Oh yes, it is. For both the companies, they have reported record high quarterly sales this time around. So let me start with Godrej Properties first. Sales value, which is up 24.5% on a quarter-on-quarter basis to come in at 4,000 crore rupees. Sales volumes are higher as well, 25% on a YY basis at 5.25 million square feet. Collections, a big surge on a quarter-on-quarter basis, up by 127%. The good part is that the company has surpassed their FY23 booking guidance of 10,000 crore rupees by 22%. So right now it stands at 12,232 crore rupees. They say they have a stronger launch pipeline in the current year that they've not seen before, and that is something which is exciting the street as well. Additionally, there is a Motilal Oswal upgrade that has come in for Godrej Properties. They have upgraded it to a buy. They say that company has reported a four-fold jump in their sales to 8,000 crore rupees till the last financial year, and this was driven by over 100 million square feet of project additions that the company did. Market share has expanded to 8% versus 2%, and they estimate that company will be able to add 38 million square feet of projects in coming years, and company is also targeting 20% growth in their pre-sales in next 4 years. That could take it to 20,000 crore rupees by FY26. They expect the annual launch run rate to double to 20 million square feet. These are the growth drivers they think is going ahead for the stock. For Sobha as well, it was a good quarter. Bengaluru saw sales flat on a YY basis. NCR saw a dip, but Kerala saw good growth, and that is something which led to good growth this time around. In Q4, sales value is up 26% on a YY basis. Sales volumes are up 8%. Realizations too went up by 14% for the company. And as I said, Bengaluru was flat, NCR was lower a tad bit, and Kerala was higher this time around. Company said they launched the first project in Hyderabad and overall launched 3 projects with saleable area 1.06 million square feet. It's a good commentary and good update, something that the street is liking.
Oh, thank you very much for that. Shobha is up close to about 3.5%. We've been talking about, right, how Bangalore may perhaps see a slowdown because the technology sector, hiring, the employment, etc., the labor market, the tech labor market has been slowing down, and Shobha as well has reported flat sales in the city of Bengaluru. But let's talk about CreditAccess Grameen. Now, the stock is higher by 2% in trade, but it's come off sharply from the day's high. Pull up that intraday chart, and you would see the slide from the early morning levels of almost 1,040. Abhishek is here with the details of their Q4 business update. Abhishek.
Well, as you mentioned, CreditAccess Grameen did come out with its business update. Now, one trend that is being seen across lenders is that the tenure of the loan book is actually increasing. So take a note that in the EMI, the proportion of interest payment is actually increasing and principal repayment is reducing, which is leading to higher tenure or higher disbursal to AUM ratio for many players. So disbursals growth is at 24% YOY and about 48% quarter-on-quarter. The AUM growth is robust at 26.7% YOY and more than 18% quarter-on-quarter. Disbursal to AUM ratio for our MFI is 45%, which is very strong, but it may not be sustainable given the fact that 45% is the kind of disbursal to AUM ratio you see for products having a tenure of 4 years, 5 years, or even more. So calculation shows that average ticket size is up 12.3% YOY and more than 18% quarter-on-quarter. Quarter-on-quarter, the number of clients or the number of customers have remained flat. Investec has written on CreditAccess Grameen. They have a buy recommendation. They have increased the target price to 1225 from 1200 that they had earlier. They say that the AUM growth is 3% higher than their estimate. They expect CreditAccess Grameen to report strong Q4 in terms of return ratios, which is ROA and ROE. So they expect ROE of 23% in FY24 with an AUM growth of 24%. So they have upgraded their estimate 3 to 4% on AUM growth and about 7% to 10% for PAT between FY24 to FY25. Back to you.
All right, Abhishek, thanks a lot for bringing us all of the details on CreditAccess's Q4 update. By the way, important flashes at the bottom of your screen. We were telling you about the CNG price cut across the board, right? So GAIL has also gone ahead and cut CNG prices by 6 to 7 rupees per kg and PNG prices by 6 to 7 rupees per SCM. Of course, we were mentioning since the morning, MGL, IGL, Gujarat Gas have all affected similar price cuts, in that range of around 6 to 8 rupees. So now GAIL has also cut CNG prices by 6 to 7 rupees per kg. So that's an important flash coming in. But with that, we do need to take a break. When we come back, we're going to discuss the technicals of this market. Mitesh Thakkar will be with us.
Welcome back. Now, the other auto names have started moving up. So, Tata Motors continues to be in pole position with a 6% gain, and that's trading firm, holding on to all its gains. But now, even the other stocks, like a Hero MotoCorp has moved to the high point of the day. That's got a gain of 1%. M&M too is started rallying. So, M&M is up more than 1%. So, that's the update coming through on the auto names. But let's talk about the market technicals. Mitesh Thakkar is now joining us for a technical check on the markets. Mitesh, in the morning, you had a bullish bias. You said this is a buy on dips market, and you were going with all long calls. At 11:20 right now in the morning, what's the reading on the market and the way forward?
I think nothing much has changed except for the fact that it's been a slower day. But broadly, I think that is because some of the weekly averages, which are around these levels of 17,600, 650 zones, are kind of acting as some kind of a supply point. So the bias doesn't change. I still maintain targets of 17,780, 17,800. Only thing is that from day point of view and looking at the fact that last 5 days has given us a rally of about 800 points, I think it might be a bit prudent to possibly wait for some kind of intraday dips to buy afresh, which should be closer to about the 200 average. So anything closer to about 17,560, 550 zones, very welcome buying opportunity. But the overall bias remains on the long side, not advising fresh longs right now. But on stock side, as you were highlighting, I think a couple of auto names, have broken out, and Hero Motors, you just mentioned that was a buy call last week as well. But now it's showing signs of continuation after 2 days of sideways activity. So buy here with a stop at 24.25 for targets of 25.10. And the power twins are doing very well, which is REC and PFC. And I've suggested a buy on REC, which I would recommend buying with a stop at 118.5 and look for targets around 127.
All right, got that. Mitesh, thanks a lot for joining us with that quick check on the market. But with that, let's talk about another stock which is holding up quite well today. That's Titan. It's come off the highs, but it's still holding up after its jewelry segment had witnessed 23% growth in Q4. This is, of course, in a weak base that's coming through. Mangalam is here with the details. Mangalam, the non-jewelry biz also really shining.
That's correct. So for Titan this time around, it's been a decent update as far as the fourth quarter is concerned. 23% growth in their jewelry business. This, of course, comes on a feeble base of 1.3% growth. Remember, same time last year, we were all battling, Omicron-led disruptions and a sudden spike in the gold price on account of the Russia-Ukraine war as well. But on that, the company has done well. What's really stood out is the non-jewelry business as well, which has done extremely well on a low base. So overall revenue for the company this time around has grown by 25%, jewelry business 23%. And what have the non-jewelry businesses done? Watches up 41%, emerging businesses, which include fragrance and fashion accessories, up 84%. Taneira, saris business that they've gotten into, also did about 208% growth. Importantly, large ticket purchases were led by a rich mix of high-valued studded and solitaire business, which is margin accretive for the company. However, March saw a bit of slowdown in consumption because of yet another spike in gold prices. However, the street believes that maybe this will reverse. We have Macquarie saying that demand at lower price points seems to be recovering, and demand softening in March may recover in April itself. They have an overweight rating on the stock with a target price of 32.50. And Goldman Sachs says that this strong outperformance, despite tough macros, is an outlier, and which is why this is their only and rather top pick in the consumer discretionary space.
Okay, thank you very much for that. In the month of April, at least, it's a seasonally strong quarter because you have a few auspicious days. I think Akshay Tritiya falls in the month of April. So let's see what the trends look like in this month. Thank you very much, Mangalam, for that. What we'll do is slip into a break, and as we do that, we'll listen into what Tahir Badshah of Invesco Mutual Fund had to say about the current market action, the outlook for earnings, and his sectoral bets.
There has been a one negative development from a global standpoint, which is around US, centered around US banks and the repercussions thereof. And then there is a good development over the weekend that, at least for some reason, the RBI has chosen to pause, and that takes away some bit of the multiple pressure on the market, pressure on multiples rather, on the market. I think we're looking forward to some interesting outcomes of this season to be able to judge as to whether earnings can now hold up as we expect or as the market expects. There is probably reason to believe that the worst is behind. We need to get into specifics of the Indian IT services companies, and we'll hear a lot more as the quarter goes by and we get the quarterly results. Industrials from the point of view of whether they're able to hold up and deliver to the promise.
Welcome back. Tata Motors is the top Nifty mover. We've been talking about this, since the morning. It's up over, 5%, almost 6% higher in trade. This after total global sales surged 8%. This is for Q4 of FY23. So Sonia's here with what brokerages have to say about the performance and the stock now. Sonia.
Well, thanks a lot for that. As you rightly pointed out, very good numbers coming in from Jaguar Land Rover in Q4. In fact, the global wholesale numbers are also looking good. It's almost a double-digit growth that we've seen. Total global sales are up by almost about 8-odd%. Within that, the passenger vehicle sales are up by about 10-odd% on a year-on-year basis. But the good part is that Jaguar Land Rover sales have seen a good growth on a quarter-on-quarter basis as well. If you compare it, it's almost a 20% growth that JLR sales have seen. Now, a lot of brokerages are bullish on the stock. In fact, Goldman Sachs this morning has upgraded Tata Motors to a buy. They've also raised their target price from 480 to 550, which implies a 26% upside. Their main reason for upgradation of the stock is that the valuations are looking attractive now. So they say that the stock is trading at 7.5 times PE on FY25 estimates. This compares to their own historic median of around 9 times. So it is cheaper than its own historic valuations. Not just that, BofA Securities has said that the volumes are solid in Q4. There's also a free cash flow beat for Jaguar Land Rover. They can achieve their net debt-free guidance as well that they had laid out by the end of FY24. They maintain a buy with a target price of 475, and they say that the risk reward is favorable at current levels for Tata Motors. Back to you.
Thank you very much for that. One of the other big highlight points is the free cash flow, which Sonia was referring to. So this quarter, the free cash flow is more than £800 million, right? In the Q3 earnings call, the management had said that the Q4 free cash flow will be less than the Q3 free cash flow, which was £490 million. So this free cash flow number of £800 million plus that they've reported in Q4, or they're anticipating, has actually come in as a big positive surprise, because that changes their debt reduction trajectory completely. But let's welcome Siddharth Khemka, the head of retail research at Motilal Oswal Financial Services, on the show now. Siddharth, Tata Motors is a stock that you like very much. Goldman believes the valuations are attractive, the numbers are very encouraging, their debt reduction trajectory appears to be on track, or perhaps they might even exceed that and better it. Thoughts on Tata Motors after the up move that we've seen today? Can retail investors still go ahead and buy?
Yeah, very good morning, Deepa. I think the updates from Tata Motors have been very encouraging. If you look at the overall auto pack, what we have seen is that after a very long time, things have changed in favor of the entire auto space. We did a report sometime back where we said that the overall auto pack is coming back from the brink. Last 4 or 5 years, there was, apart from the supply chain issues, there were other issues such as higher cost of ownership, lower affordability, the chip shortage, and things are now becoming much better with the companies being able to pass on the cost inflation at the customer level, the realization of the pent-up demand, and improvement in the overall supply chain issues. If you look at specifically the Tata Motors, I think the update from the company is very encouraging. Not only the business update about the growth that the company is able to do in India, and the strong growth in the JLR business. What is encouraging is that the company has indicated that the free cash flow generation for JLR will be much higher than what they had initially earlier indicated. So I think that is something positive. The FCF of 800 million in Q4 is much higher than what they were earlier expecting, about less than 500, which would lead to the company becoming net debt negative. So the net debt will become zero in FY24, and that is a big positive. So overall, if you look at Tata Motors, I think the three business segments are showing strong growth. The Indian CV business is likely to see a recovery with the capex and industrial cycle. The Indian passenger vehicle is on a strong footing, mainly led by the newer models and the EV segment. And while JLR is now also seeing a strong recovery. So all the three cylinders are firing. I think there is a good upside potential. Nonetheless, today the stock has moved up, so investors could wait for a day or two, but I think we see a good upside from current levels as well. Currently, we have a target of 525 on Tata Motors, with 50% of the value coming in from the domestic business.
All right, you're sounding very optimistic on this one, Siddharth. Thanks a lot for joining us. You know, another stock that you are sounding positive on is Vedant Fashion. Take us through what your call on this is. Why are you so positive on this stock, and what is the kind of upside you see here? Because it has seen a near 20% cut in this year itself, right?
Yeah. So, Pavitra, if you look at the entire retail space, I think the companies did well post the reopening after the lockdown, and we saw huge pent-up demand. Valuations went up the roof. And now with the last quarters, the consumption demand kind of slowing down, we saw the stocks as well as the valuation coming to comfortable level. This is where we started liking Vedant Fashion, which is present in the niche segment, which is the ethnic wear segment, which is highly underpenetrated and unorganized in India, with just 20% of the entire market being branded so far. So we feel that Vedant has a very strong brand in this niche segment. It has a decent growth story, and as we have seen that the in India, the marriage related, so for example, the jewelry segment for Titan keeps growing year after year. So Vedant also caters to a large segment, which is the demand comes from the marriage season, and that is something that could keep the demand strong in an otherwise somber consumption environment. So that gives us much confidence on the growth going forward. So we are expecting about 20-21% of revenue PAT CAGR over the next 2 years, of which 15% will be driven by the new stores addition. Overall, limited competition, growing strong cultural pull, and a very strong brand makes us positive on Vedant. The correction also offers a decent entry opportunity. We have a target price of 1400 from a 1-year perspective.
1400 is the target price on Vedant Fashion, the owner of Manyavar. You like ICICI Bank as well. Is it just ICICI Bank in the private sector financial space, or is it your top pick in the private sector financial space, or you like the entire basket and you only want to talk about ICICI Bank today?
So, Dima, if you look at the earnings, I think the quarterly earnings have clearly been driven by financials. Although the pace of growth is now, you can say, consolidating, and is now margin coming close to growth is consolidating. But I think two sectors which are clearly driving earnings growth would be your financials and auto. So I think the private financial space would continue to do well. Within that, our preferred picks have been the ICICI, SBI and Axis, but ICICI having underperformed for quite some time now. I think with the other banking companies coming out with strong business updates, we believe that again, after underperforming, ICICI is a good entry opportunity at current levels. The overall business remains quite strong. For ICICI, it has been able to increase its PCR to 83% as of Q3, which is among the highest in the industry. It has been well cushioned with higher provisions and on its balance sheet. We expect normalizations of the credit cost from FY23, so that is also positive. The margins are expected to remain strong with growth in SME and high-yielding retail segments. We expect 18% loan CAGR for ICICI over the next 2 years, with strong return ratios, ROAs of 2.2% and 17% ROEs. So I think a good entry opportunity again in a private sector bank with a decent growth.
All right, Siddharth, very helpful to talk about all of these individual picks, ICICI Bank, Vedant Fashions, as well as Tata Motors. We leave it at that, but we hope to have you back again soon and discuss lots more ideas. For now, we are going to get into a short break on the show, but as we do that, here's some interesting opinion. This comes in from Venugopal Gare of Bernstein. They have a big rebound call on India, so check out what they have to tell us.
if you were to see the last 18 to 20 months, India has been broadly flatlining, pretty much in a range-bound sort of a market. And in somewhere down the line, you can call it a bearish sort of a market, even from a global perspective. And you tend to see bear market rallies from time to time, these sort of rebounds and then, sell-offs, which is quite common if you look at the past 18 months as well. Normally, we tend to ignore, quite a few of these bear market rallies if they're pure valuation-led. I guess the reason why we decided to call a rebound this time was largely because it was not just pure valuations. I guess our perspective was more led by the fact that we were also seeing macro bottom out. Our thinking primarily is that real estate is still early cycle now, which primarily means our old school thought process that this is like 7-8 years of downturn, post which we've seen 1 year of upturn. Given that we're still off the bottom, affordability has increased, and of course, volumes in real estate would have mopped up some bit of inventory over the last 12 to 18 months. You'd start to see a new cycle or a new start cycle commence, which is where construction starts, which is where cement is going to be that early cycle play when you start to see real estate construction increase or improve in terms of volume. So both are linked to each other in some way. And that's the reason why, this was a part and parcel of the call apart from financials, which we were highlighting as a way to play this rebound.
Welcome back. The Nifty is still very much in the tight trading range of about 50 to 60 odd points. It's 17,647. There you have it. The range is just about 55 odd points in today's trade. But individual stocks catch your attention, and one of them is IGL. Now, IGL started trade higher. It, in fact, opened around levels of 470, but from there, IGL has slipped quite a bit and now is in the red. But bear in mind, in this month itself, IGL has seen a fair amount of rally of close to about 7 odd %. So, a lot of the good news perhaps has been priced into. But now let's talk about the financial space, the banking space. And this is our special segment, FinStreet. My colleague Abhishek is standing by with details on the credit cards performance for the month of February 2023.
While credit card spends have declined massively in Feb on a month-on-month basis, the card issuances has remained healthy on a month-on-month basis. The decline in spends is on expected line, with a decline in rental payments believed to be a key culprit, as paying rents via credit card now attracts a charge. Let's now take a broader look as to how February has panned out for the credit card sector. Total credit card issued is up 16.3% YOY and about 1.11% on a month-on-month basis. This compares to about 17.5% YOY and about 1.6% month-on-month growth that you saw in Jan 2023. Total spends are up nearly 38% YOY in Feb 2023 versus 45.5% growth that you saw in Jan of 2023. Now, total spends are down 7% month-on-month in Feb 2023 versus a growth of 0.91% month-on-month that you had in Jan 2023. If you compare Feb 2023 and Feb 2022, the spends per card is down 8.1% month-on-month in Feb of this year versus a decline of 4% that you had in Feb of last year. Total card issued is up 1.11% in Feb of this year versus 2.1% growth month-on-month that you had in Feb 2022. So total spends is down more than 7% month-on-month in Feb of this year versus a decline of just 2% in Feb of last year. So clearly, February saw a decline in spends month-on-month in both the years, but the decline is sharper this year. Let's take a look in terms of the top 4 performance. In terms of card issuances, their market share has declined sharply from more than 73% in Feb of last year to right now about 68%. SDFC Bank, ICICI Bank and Axis Bank have lost market share YOY. SBI is the only player to gain market share in terms of card issuances amongst the top 4 on a YOY basis. So in terms of spends, the market share of the top 4 has declined from 73.75% in Feb of last year to right now a little under 72% in Feb of this year. HDFC Bank is the only player among the top 4 to gain market share in spends YOY, that is year on year. HDFC Bank has gained about 193 basis points in terms of market share in spends. This compares to a decline of 358 basis points for ICICI Bank, 20 basis points for SBI and flat for Axis Bank. Let's take a look in terms of per card spends. YOY, the per card spend is up 18.6%. 18 lenders have seen growth rate being better than industry average. Now, players who saw spends doubling or more are CSB Bank, Bank of Maharashtra, Canara Bank, City Union Bank and Bank of India. 15 players saw their spends below industry growth rate, with SBM Bank India and IDFC Bank losing the most. Month on month, industry level, the spends declined by 8.1%. So top losers in spends per card on a month-on-month basis are City Union Bank, CSB Bank, DBS Bank India, Federal Bank, HSBC, Axis Bank and SBI Card. So the key takeaway and outlook. Spends have declined in Feb 2023. Now this may have been led by RBI ruling charges on rents being paid via credit card. Expect the trends in spends to remain soft in the coming months as well. Card issuances have remained healthy and the momentum is expected to sustain. The top 4 are losing market share. This is a big surprise. Consolidation is happening in the sector. Axis Bank's numbers will improve due to Citi acquisition, which will help the market share of top 4 players in the coming months. Now, Bank of Baroda and IndusInd Bank will likely move up the ranks, with Citi moving out. Also, credit card spends may get a hit by the recent RBI announcement of pre-sanctioned credit lines by banks via UPI.
All right, Abhishek, thanks a lot for bringing us that very detailed picture on the credit card picture in India right now. But with that, we do need to move into a short break. When we come back, we're going to bring you our special segment, Quarter Se Quarter Tak, where we will analyze the expectations from big tech in Q4. Stay tuned. Welcome back. You're still tuned into Trading Hour. For the market, we are seeing a little bit more of an a move higher. So it's up 60 points right now, but the banks are where we continue to see some pressure. So we'll talk more about that. But what's in focus ahead of the Q4 earnings season kickstarting is the IT pack, because we have TCS, which goes first on the 12th of this month, and then you have Infosys on the 13th. So Rima is standing by at the big wall with all of the expectations from big tech in this quarter. Rima?
Thanks so much for that. So this is going to be one of the trickiest quarters to lay out expectations, considering that we are in a heightened period of uncertainty. Just look at the broad divergence in expectations. So for instance, for TCS, the range of the constant currency quarter-on-quarter revenue growth ranges from 0.1 to 1.7%. For Infosys, it goes from minus 0.1 to 1.1%. But look at the numbers for HCL Tech. Now, CLSA is expecting a degrowth of 2.9%, but Nomura is expecting a growth of 1.1%. So the expectations are all over the place, but as you can broadly see, the growth this quarter is going to be lower than the prior quarter. Q4 less than Q3. And the key reason for that is the banking crisis in the US regional banks and the European banks may have induced a greater caution, impacting the overall tech spends by banking clients. And plus, typically, March is a seasonally weak quarter. Now, the margin performance amongst large cap is also likely to be more divergent. Now, for TCS, we're anticipating about a 50 basis points margin expansion, but for HCL Tech, margins could come down on a quarter-on-quarter basis. The key is going to be the FY24 guidance. And here we're anticipating Infy to be conservative and guide for a 6 to 8% revenue growth, constant currency revenue growth. But this will be lower than the 16% odd that they clocked in last year. That's FY23. But Infy is Infy, so we're expecting them to be fairly conservative. For HCL Tech, again, it's very hard to get a consensus this time on guidance, but it looks like it could be a mid to high single-digit kind of growth because you've got a minimum of 4 to 6%, and you've got some analysts even going up to about a 10% growth. But both HCL Tech and Infosys are likely to range the upper end of their margin guidance. These are the numbers. For Infosys, 21 to 23% versus this year's margins at 21 to 22%. So the upper end of the margin guidance is likely to be raised. Now let's quickly run you through some of the brief and quick expectations of what we are going to be watching out for. 1, the extent of impact due to the global banking turmoil on deal wins. 2, retail, high-tech, Europe. These were flagged off as some of the weak pockets in the prior quarters. Does the weakness continue this time? Will normalcy return in the second half of FY24? Because what analysts are penciling in is that H1 is going to be weak, but things pick up in the second half of the year. Company-specific TCS is eligible to announce a buyback. It's eligible, but will it do so? Leadership changes have been announced right at the top for TCS and Tech Mahindra, so they will take center stage. And any change in priorities, strategic direction, new appointments as well, right? Under them. Now, TCS has to announce a new BFSI head. The COO, Chief Operating Officer, will be resigning or retiring next year. And finally, on deal wins, are we seeing a delay in deal ramp-ups? Are sales cycles getting longer? Is there slower revenue conversion? So all these are some factors that we will be watching out for. And finally, considering that the IT stocks have seen a bit of a correction, the valuations now are pretty much what they were compared to their 5-year average. So are they pricing in the uncertainty, the uncertain environment that we're currently living in? Back to you.
That is the big question, and we're going to wait by and see how that goes. We don't have too much longer to wait. IT earnings kickstart this week, like we were telling you. By the way, right now also there's quite a move higher in the IT pack. So take a look at the Nifty IT index. That's seen a big move higher at the high point of the day. What's clearly doing the best today is Tech Mahindra. So that one is seeing a good move up. But the rest of the bigger names as well, whether it's in HCL Tech, Wipro, all of these holding up just fine. The other space which is doing good is the real estate space, like we were telling you, for the second straight day. Of course, it is a rate sensitive area, and we did see a big move on this space on Thursday as well after the RBI policies. And today you have a lot of the updates which have come through, whether it's from Godrej, Sobha. Some of the smaller names like Ajmera Realty are now up almost 6%. So that entire space is really buzzing as well. On the downside, banks a little bit soft. You have Reliance, which is soft, and a lot of the consumption companies. So the likes of, Tata Consumer seeing some cuts, HUL seeing cuts, Britannia, Nestle has also moved into the red. So that entire space is definitely a bit soft today. But that's the shape of the market. We will leave it on that note today. Thanks a lot for tuning in. We have halftime report, which comes up in just a bit to take you through the rest of the trading action.